Hello, good morning, everyone.
Yeah, good morning,
Good
sir.
morning.
Okay, so we have one more person newly joined. Welcome, Anil. How are you?
Yeah, I'm fine, sir. Good morning.
Okay, Anil,
Yeah.
can you please introduce yourself?
Yeah. I'm Anil. I'm from Kakinada, and I've worked for 2.5 years at Infosys as a systems engineer. Yeah,
Okay,
that's my background.
okay, all right. Thank you, Anil.
Yeah.
Welcome to Astra Workforce and for underwriting training. Okay, so yesterday we started. Okay, we just started the basic information about the US mortgage underwriting. Okay. Anil, just tell me, do you have any idea about the US mortgage underwriting? What is it really?
Yeah, I've gone through your demo session yesterday.
Okay.
Come to know that US mortgage underwriting is a loan agreement.
Mm-hmm.
Okay, he will inspect all the risks and he will decide whether the loan has to give it or not.
Okay. Okay.
Yeah.
Fine. Okay. So nothing but the US mortgage is like the loan agreement or legal agreement between borrower and
Borrower
the
and
lender.
lender.
Okay, for given period, given rate, and so the borrower needs to pay the EMI to the lender. Okay, so he have to assured and signed that he'll be paying all the EMIs on time. Okay, to avoid the foreclosure. Okay, so but this in this US mortgage, property will act as a collateral. Okay, so the borrower will give you the loan amount based on your property. Okay, so that's called as a US mortgage. Okay, let me share my screen. We'll discuss.
Okay.
Okay, so I'm going to take again about mortgage life cycle and types of mortgage. Okay, so the mortgage life cycle is nothing but these all the stages involved in the mortgage. Okay, once all the processes completed, borrower will get the loan amount from the lender. Okay, the first point, that is a first process, you can say, there is a origination. Okay, origination is nothing but borrower is approaching to the lender, okay, to get the loan amount. For that, okay, borrower need to fill the form, that is uniform residential loan application. Okay, that's a 1003. Okay, so you need to fill all the information in this 1003 document. 1003 document uh, with all the information like personal information and career information. There is employment details. Okay, what all the asset he is having, what all the debts he is having. Okay, if he has any additional properties as as a REO. Okay, so this all information will be updated by the borrower in this stage. Okay, so once that is done, okay, so borrower will submit the application to the loan originator. Okay, and originator will give the set of document to the borrower, like that is called as the initial disclosures. Okay, so initial disclosures as uh, loan estimate, service provider list, homeowners counseling list. Okay, the loan estimate is nothing but the cost of loan. Okay, so what are the costs involved in the you can see the closing costs. Okay, so the processing fee, underwriting fee, application fee, and is there any title fees or whatever it is that is related to the loan to process while processing the files. Okay, that cost will called as a closing cost. Okay. Once that is done, okay, the file will be moved to processing. Okay, the processing is like the processor will have separate set of guidelines to be followed. Okay, so the processor main job is to collect the documentation from the borrower and the employer, and he'll be the processor will be verifying the employment history of the borrower, and whether you'll be checking the employment status of the borrower. Okay, and one that is done, the file will be moved to underwriting. So the underwriting is nothing but uh, the underwriters will determine whether the lender can approve the loan or not. Okay, so underwriters, as you guys are very uh, important, playing an important role in this stage. Okay, so maybe borrower will maybe apply the loan with the teams or whatever it is he has, but if the underwriting is failed, the loan will not be uh, credited to the borrower. Okay, so in that underwriting, we have four C's to be checked. Do you know what is the four C's?
Credit, capital, capacity, and collateral.
Yes. Okay, so these all the four C's we will be going to discuss in detail. Okay, along with your live examples. Okay, also you'll be getting a case studies, you'll be getting questions and everything, question answer sessions like that. Okay, okay, so the underwriting, once the underwriting is done, that will move to closing. The file will be moved to closing. The closing, the all the documents will be getting signed by the borrower, lender, and what other parties available involved in the loan processing. Okay, so also the fund will be dispersed to the borrower. Okay, this is a mortgage life cycle. And so whenever you're going for the interview, right, so the basic question the management will ask, the interviewer will ask, what is a mortgage life cycle? So you should be ready to answer for that questions. Okay, all right, any concern and doubt on this?
No, sir.
Okay, thank you. Now we are going to discuss about types of mortgage. Okay, there are you can say there are four types of mortgage we have. Okay, one is FHA, conventional, VA, and USDA. Say it again: FHA, VA, conventional, and
Yes.
USDA. Okay, so FHA. Anil, can you please read it out?
FHA, Federal Housing Administration. A Federal Housing Administration loan is a home mortgage that is insured by the government and issued by a bank or other lender approved by the agency. First-time house buyers may find that FHA loan is the most affordable mortgage option. Due to FHA insurance, banks are more willing to lend home buyers with low credit scores and small down payments. FHA loan criteria allow for borrowers with a lower than average credit score of at least 580 to qualify for FHA insured mortgages.
Okay. So the FHA loan is very more affordable, or so you can say it is very easy to access or easy to go through the guideline, because this is called as well the government loan. Okay, like we have SBI Bank, Indian Bank, and IOB, right? So they will give the loan amount, but not that much loan amount. They will give the loan amount, but with the lower interest rate. Okay, but they will not give higher loan amount. Okay, but so for those who are having, or those who are doing the first time purchase, okay, and this program will be help them to get the loan. Okay, for FHA loan, the minimum Q score, the minimum credit score is 580 to qualify in FHA insured mortgage. Read it.
The FHA mandates that the loan to value ratio cannot exceed 96.5 of the value of home with the FHA loan. In other words, you can have a down payment as low as 3.5% of purchase price, meaning you can qualify for FHA financing of up to 95.5% of the property values. If your credit score falls between 500 and 579, you can still get FHA financing, but you will not need to make a down payment of at least 10%, meaning you can only finance up to 90% of the property's value. Loan limits the range from 5,24,225 dollars to $1.2 million.
Okay, great. So, FHA files, okay, the down payment also very less. Okay, so the loans will approved till 90% or 95% as well. Okay, let's say if the loan amount, the borrowers applied for $100,000. Okay, and you'll get up to $95,000, and the $5,000 will be as a down payment. Okay, so that level of leeway we have in FHA, but there's a limit for the loan amount also. Okay, so you can say the loan limit is $524,000, okay, to $1,209,000. Okay, this is the loan limit for FHA. This is a drawback in the FHA, because those who are having multiple property, okay, if they are applying a multi-unit property, if they are applying for a loan, FHA, it's very difficult to get the loan. Okay, for private sector, they will easily approve the loan, like it's like 10 million, 20, 25 million, like that. Okay, so do we understand what is the FHA loan program? Any questions?
No, sir.
Okay, so in this topic, you will get the questions from the interview, like what is a credit score for FHA, minimum credit score for FHA files. Okay, that is 580. Okay, now this is a table, actually the loan limit. Okay, I'll be sharing those. Okay, so that you can verify. I don't want to waste the time to spend over here. Okay, let's move on to conventional home mortgage. Okay, conventional home mortgage, nothing but it's a private lender. Okay, like we have HDFC, ICICI Bank, Axis Bank. Okay, they will give more loan amount, but at the same time, the interest rate also will be higher side. Okay, because the risk is high.
Yeah.
Okay, yeah, please read it out.
Conventional mortgage is a home buyer's loan made through a private lender. Conventional loan requires a higher credit score to qualify. Conventional loans are not offered or secured by a government entity. Instead, these mortgages are available through private lenders such as banks, credit unions, and mortgage companies.
Okay, so private lenders, okay, private banks, or else you can say private financial institute. Like we have, do you guys have any idea what are the uh, non-banking financial institute we have in India? What are those?
Banking, financial, which means private banks or
The private bank, so not a bank, it's a financial institute. I'm saying
IDBI.
IDBI. Okay.
I'm not sure, but I think
Okay, yeah, IDBI is it's not a bank only. They are the financial company. Also, you will be having Fullerton. Okay, Fullerton company, you can say, and these guys, the app loan, right? So most of the people will get the app loans and everything.
yeah,
Okay, there is
yeah.
also like non-banking uh, institutions, okay, or else
Okay.
you can say non-banking financial companies. Okay, so these guys will be given you the higher loan amount. Okay, they will be approved a higher loan amount as well as the credit score also, the interest rate also is a higher side. Okay, say for example, if government banks, okay, they are approving the loans with starting with 8% or 9%. These guys will, the private lenders will start with 12% or 13%, till 24% or 36% also they will approve. Okay, so that depends on the borrower's profile, borrower's property value, and the credit scores. Okay, all right. Please read it. Continue.
Some conventional mortgages can be guaranteed by the two government-sponsored enterprises, the Federal Nation Mortgage Association, Fannie Mae, and the Federal Home Loan Mortgage Corps, Freddie Mac.
Okay, hold on. So, so the Fannie Mae and Freddie Mac, these guys are investors. Okay, they are ruling entire U.S. mortgage. Okay, you can say that. Okay, these guys are uh, based on their guideline only. All the mortgage loans are getting approved in U.S. mortgage, especially for Fannie Mae. Okay, so what are the slides I'm giving you, right? So this everything based on the Fannie Mae guideline, because all the US mortgage processes they're following Fannie Mae guidelines only. Okay,
Okay.
yeah, please go ahead.
Potential borrowers needs to complete an official mortgage application and supply the required documents, their credit history and current credit score. Conventional loan interest rates may be higher than government-backed mortgages, such as Federal Housing Administration loans. For example, you took out conventional mortgage to buy a home worth $5 lakh, had a $1 lakh down payments, that's 20%, and a good credit score of 650. You might be able to get a conventional mortgage with a locked rate in 5.5%. This would equate to monthly payment of around $2,271 on a 30-year loan just for the principal and the interest payments.
Okay, so as I said, even for down payment also, the conventional loan people have to pay higher side. Okay, so the LTV it is 80%. Okay, so 80% they have to cover. Let's say if the loan amount is $100,000, 20% they have to pay as a down payment. That is a $20,000, and 80,000 will be only approved by the lender. Okay, so the loan amount is higher side, interest rate is a higher side, and down payment also higher side for convention people. Okay, right. Now, so in conventional, we have two types of loans over there. Okay, conforming and non-conforming. Okay, conforming with the loan amount limit of maximum of $526,000. Okay, and non-conforming is like you can call it as a jumbo loans. Okay, that will, excuse me, that will start with $800,000. That's called as a jumbo loans. Yeah, please read it out.
A conforming mortgage is the one whose underlying terms and conditions meet the funding criteria of Fannie Mae and Freddie Mac. Chief among those is a dollar limit set annually by the Federal Housing Finance Agency. In most of the continental United States, a loan must not exceed $766,550 in 2024, up from $726,000 in 2023.
Okay, so the conforming loans are approved by or they are following the guidelines of Fannie Mae or Freddie Mac. Okay, these loans will be conforming loans. Yeah, go ahead.
A non-conforming mortgage is a mortgage that does not meet the guidelines of the government-sponsored enterprises, such as Fannie Mae and Freddie Mac, and therefore cannot be sold to them. GSE guidelines include a maximum loan amount, suitable properties, down payment requirements, and credit requirements, and among other factors. In 2025, loan limit in the most US countries is $8 lakh, but in some high-cost areas such as New York City or San Francisco, it can be high as $1.2 million.
Okay, so non-conforming conventional loans, as a ZEMO loans, the lender having their own set of guidelines. Okay, if the borrower meets their guidelines, they are ready to give this much amount of mortgage loan to the borrower. Okay, so the limit will start with $800,000, and that will be go anytime, anyway, right? Based on the property value and income of the borrower and this credit score, based on which they will give the loan amount to the borrower. Okay, so this will not sold, or these loans will not be reviewed as per Fannie Mae or Freddie Mac guideline. Okay, they will have different guideline. There is a lender guideline, you can say. Okay, let's say the Fullerton and other private sectors, they have their own guideline to be followed to eligible to get the loans. Okay, like that. The US also, the lenders will have their own guidelines to be approved for the loans. Okay, so that will be comes under the jumbo loans. Okay, VA loans. Read it, please.
A Veterans Administration loan is a mortgage offered through US Department of Veteran Affairs program. Veterans Administration loans are available to active and veteran service personnel and their surviving spouses and are backed by the federal government, but issued through private lenders. VA loans have generous terms such as no down payments, no mortgage insurance, and no prepayment penalties. VA loans helps active service members, veterans, and their surviving spouses becoming homeowners. They provide up to 100% financing on the value of their home. Eligible borrowers can use VA loan to purchase or build a home and improve and repair a home or refinance or mortgage.
Okay, so this VA loans only, this is specially designed for defense people. Okay, so you can say army people. Okay, for them there will be no down payment, there will be no mortgage insurance, there will be no prepayment penalty. Do you have any idea what is the prepayment penalty, Anil?
No, sir, I don't have any idea.
Okay, so prepayment penalty is nothing but, okay, so now you are the borrower. Okay, you had a loan, okay, property loan with amount of $250,000. Okay, but
Okay.
you have completed your EMIs for 10 years out of 30 years. Okay, now your outstanding balance is $180,000. Okay, now you're planning to close that as well. You have a cash and you are planning to close that. Okay, so in order to close, okay, you'll have to pay prepayment penalty as a 3% or 4% or 5%, depends on the loan agreement which you have signed. Okay, along with your outstanding balance. That is called as a prepayment penalty.
Okay.
Okay, so in VA files, for VA borrowers, there is no prepayment penalties. They will get 100% loan amount. There is no down payment required for them. Okay, also there is no prepayment penalty for them. Okay, so who are eligible? So those who are in active service members, okay, those who are currently working as an army, or those who are retired from service. Okay, also, and their surviving spouses. So these people are eligible to get VA loans. Now, so we have types of VA loans. You can say it's not only for the VA loans. You can have it in the you'll have it in the VA conventional and FH also. Okay, so purchase, cash out refinance, and interest reduction. Okay, purchase is nothing but the purchase of home loan the first time, or else if the borrower is purchasing the loan as a investment property. Okay, this will be comes under purchase. Now, what is the cash out refinance? Cash out refinance is nothing but mortgage holder to borrow against the home equity to pay off the debts or whatever the fund needed. Okay, there can be a financial, it can be a emergency, medical emergency, or any requirement like school fees or home improvement or marriage, whatever it is. Okay, so for that, the borrower will get cash in hand. That is a cash out refinance. Okay, interest rate reduction refinance. That means the interest rate reduction is like the borrower having the VA loan already. Okay, now is he need to reduce, he wants to reduce the interest rate what is currently going through. For that he is applying the loan again for VA and he will get lesser interest rate. That is called as a interest rate reduction refinance. Okay, any question on this?
Can you please elaborate these three? And I mean not elaborate. A
Yeah,
quick example.
I'll do that. Wait, let me even I type the types of transactions you can see. Okay, you can check the chat. I'm going to type it over here. Okay. purchase. Of mortgage loan subject property will act as a collateral. Cash out refinance. Borrower will get the loan to pay off their existing loans and remaining amount will be credited borrower's account. Okay, so cash out refinance, borrower will get the loan to pay off their existing loans. Remaining amount will be credited to the borrower's account. Okay, and the limited or return term refinance, the lender will pay off the borrower's existing loan amount. Let's say I have 5 loans. Okay, 5 EMIs going on. Okay, now I'm applying loans to another bank. Okay, so he'll be giving the checks to all my existing lenders, all the existing my banks. Okay, he'll be paying off all the debts on behalf of me, but he'll be creating one single loan instead of 5 loans. Okay, I'll be having only one loans with the new EMI amount, new interest rate. Okay,
Okay.
and we can also, this is called as a debts consolidation loan.
Okay. And this is only for VA persons, veteran.
No, all the process, all the program.
Okay. Okay.
Okay, the transaction purchase, refinance, limited refinance or no cash out refinance, it's for all the transactions, all the mortgage type. Okay,
Okay.
no cash out refinance. So no cash out refinance. Lender will pay all the payment. Okay, but we will not get, the borrower will not get any single penny in hand.
Okay.
Okay, so we'll be creating new loan for that. That's it. Okay, this is the transaction type. Okay, refinance. Okay, cash out refinance, limited or return term refinance, and no cash out refinance.
Okay.
Okay, so and we have lot many also, but as of now, this is enough for you to understand the basics. Okay,
Okay.
let's go to types of occupancy. Okay, we
Sir,
have
can you please
yes.
go back to the last slide?
Okay,
In purchase, it is mentioned these purchase loans often do not require down payment or private mortgage insurance, right?
yeah, that's
Yeah,
for
what's
VA
the
files.
okay.
That's for VA only. Okay, not for all the
Okay.
FHA, not others loans, FHA and the conventional. They still need a down payment.
Okay.
Okay. See, all the loan programs, okay, FHA is also having purchase refinance, cash out refinance, no cash out refinance. Okay. Conventional also purchase, cash out refinance, no cash out refinance, limited cash out refinance. Okay,
Okay.
we also having purchase cash out, no cash out, and interest rate reduction. Okay, in FHA, okay, instead of interest rate reduction, they'll be having a streamlined refinance. That means
Okay.
for them we don't require to be calculate. They don't require to calculate the income for them for the borrower because they'll be having the loan details, all the details with them only, with the
Okay.
lenders only. Okay, so they don't want to do again the underwriting part. Just they will do the last transactions, how they are paying for the current loan, and then they will release for another set of loans, like a top up loans, you can say.
Okay.
Okay, any more questions?
No, sir.
Okay, can we move next slide?
Yeah, sure.
All right, types of occupancy, please read it out.
Types of occupancy: primary residence, second home, investment properties. A primary residence is a property that the borrower occupies as the primary residence. A second home is occupied by the borrower for some portion of the year, not entire his or her life. An investment property is owned but not occupied by the borrower.
Okay, so primary residence, nothing but the borrower is staying in the home.
Yeah.
Okay, he's having only one home. There's a primary home. Okay, he is staying, uh, and is owning that property. Okay, the second home, the borrower owning the property, but is not staying in that home for entire year. Okay, so like farmhouse, so he'll be going for only for the vacations, right? Like guest house, that will be used when we required. Okay, just keep it whenever we require, we can use that, like that. That's the second home. Okay, investment property, borrower own the property, but they are not occupied, they are not staying in that property. Instead of that, the income will be generated from that. Okay, so they invest invest the money in the real estate. Okay, they build a flats or apartment, whatever it is. Okay, they give that to
Rental purpose.
rental purpose. From there, they will get rental income. Okay, that's called as investment properties. Okay, so this also very important, and this will be play major role in underwriting part. Okay, because the primary residence they have different guideline, and second home they have different guideline. For investment property they have different guideline. Okay, that's what we need to understand. What is the basic? Then we can move for the underwriting. Core subject. All right. Now, see, we discussed, right? The borrower will get 80% of the loan amount and 20% they have to pay as a down payment. That is called as a loan to value, LTV, CLTV, and HCLTV. Okay, loan to value is nothing but what is a loan value? Okay, so that is determined by loan amount. Sorry. Loan amount divided by appraised value or sales price of the property. Okay, this is the formula for to calculate the LTV, CLTV, and HCLTV. Okay, so combined loan value. This is combined CLTV. Okay, that is the existing loan amount. That is a LV1. Okay, current loan amount. That is a LV2 divided by property value into 100. HCLTV, that's a HELOC amount. HELOC amount is nothing but equity amount on the property. Okay, so equity amount is as in, let's say, borrower is having the HELOC loan amounts. It's like a credit card only. Okay, so whether the borrower using or not using, that's up to them. Okay, but when we are calculating HCLTV, we'll have to be ensured that need to consider this into the calculation so that the lender will be safe in the risk. Okay, and I'll be giving the practice to calculate the LTV and CLTV and everything. Okay, don't worry about that. Okay, now the down payment assistance program. Viraj, can you please read it out?
Down payment assistance program. The down payment assistance program provides financial help to home buyers to cover upfront costs such as the down payment and closing fees, making home ownership more accessible. This assistance can come including grants that don't need to repayment, low interest loans that can be deferred or forgiven over time, or other financial incentives offered by government agencies, organizations, and the lenders. Eligibility typically depends on factors like credit score, income limits, debt to income ratio, and for some programs, not owning property in the recent past.
Okay, so down payment assistance program, that is a DPA. Okay, it is nothing but, okay, for the down payment also, in case the borrower is not able to pay the down payment, like the 20% of the loan amount they need to pay initially, right? That's called the down payment. It's the initial deposit amount. Okay, for that also the lender can will give the assistance. Okay, will give the loan amount. It's not like 30 years or 20 years. Okay, it's like 1 year period, or not even 1 year, the 5 months or 6 months period, you can say that. Okay, so for that also the lender needs to check the eligibility. Okay, depends on the credit scores or income limits or DTI. DTI is in how much income they are getting and how much debts they have. Okay, if you're doing the calculation, okay, um, total expenses, okay, total debts divided by gross income. That's a detail. Okay, based on that only, the down payment assistance will be granted to the borrower. Okay, so the down payment assistance not only in the form of cash. Okay, it can be a grant, a gift, or you can say not refundable gift kind of. Okay, we will discuss now. Read it.
Of down
Type,
payment assistance. You can read it, no problem.
Go ahead, Anil.
yeah. Types of down payment assistance: grants, low interest or forgivable loans, low interest or forgivable loans.
Okay, that is another types,
Okay.
but I didn't
Okay.
mention that. Yeah.
Okay. Okay. Grants: a gift of money that does not require repayment, often used for a portion of the down payment or closing costs. Low interest or forgivable loans: loans with low interest rates that may be forgiven if the borrower meets certain requirements, such as living in the home for a specific period.
एक second, huh?
Sorry?
2 minutes, please.
Okay, okay.
Okay, so grants is nothing but a gift of money that does not require repayment. Okay, so it can be from the the grant will be given to the borrower from the relative, or the loan also, the lender also can be given as a gift. Okay, the lower interest rate are forgivable loans. That means uh, the down payment assistance will given to the borrower with the limited, very lower limited interest rate, like 2% or 1% of the loan amount as a interest rate, or else it can be forgivable also. Okay, for some lenders, based on the prior history of the borrower, they will forgive that loan as well. Okay, these are the types of down payment assistance. Okay, any questions?
No.
Are we good?
Yeah, good.
Okay, so we are stopping here for today's class. Okay,
Okay.
so already I given the homework to. Uh, sorry, I forgot. I misspelling your
Ranchi, Ranchi.
Viranji. Okay, so already I
Yes,
given the homework, right? So to check what's the LTV, CLTV, and all, right?
yes, yes.
Okay, so same for Anil also. Okay, please do the research or search. Okay, what is the LTV? What is the
Okay.
CLTV? How this will impact the loan?
Okay.
Okay, how it is impact the approving the loans in the US market? Do that. Okay, and we will discuss in the next class.
Okay.
Okay, do you have any questions for today's sessions?
No, so all good.